If you own or you're thinking about owning NVIDIA stock, you need to watch this video before they post earnings on Wednesday after the market closes. I think the stock is extremely overvalued, and I'm going to tell you exactly why in this video. So first up, people might say, well, hey, over the last year, NVIDIA is still down 15%. Got it, okay. But over the last 5 years, the stock's up 242%, and year to date, it's up 44%, right? If we jump over to earnings, they report earnings on February 22nd, 2023, which is Wednesday after the market closes. The analysts expect earnings per share normalized to be, which is adjusted to be 80 cents, and then GAAP or generally accepted accounting principles earnings per share to be 47 cents, and then revenue estimates to be 6.02 billion. Those are the numbers, as well as their guidance for the next quarter that everybody's going to be talking about. But let's jump over here. Investing is about more than just, the price of the shares, right? We have to look at things like price to earnings multiple, price to sales multiple. And that's where I have a problem with NVIDIA right now. I love the company. I'm just not a fan of the stock. I think it's overvalued. This shows NVIDIA's price to earnings, right? The black line is the current share price. The blue line is the average PE multiple since 2011, right? And we can see really since 2017, the PE has been above 30, right? Well, we could see the normal PE ratio has been 36, and right now it's trading at a PE of 64. And so right down here is what analysts' expectations for earning per share growth is over the next 3 years, 30%, 30%, and 8%. Now keep in mind, we're in some type of an economic slowdown, right? So this is still a pretty generous 30% earnings growth for the next 2 years and then 8% for the year after. Just to give you an idea of just how overvalued this stock is, even compared to where it's historically traded, it's at a PE of 64 right now. If it drops down to a PE of 36, which is much more reasonable by 2026, then you're looking at a total annualized return of 1.2%, right? Almost no annualized return. So let's go a little further out with analyst expectations though. Through 2027, analysts are expecting revenue to grow by about 13% per year, or compound annual growth rate of 13%, which means revenue would grow from 26.9 billion in 2023 to 49.6 billion in 2027. That's over just 4 years, almost doubling revenue. Then when we get down to net income, they're expected to have net income grow from 8.2 billion in 2023 to 18.2 billion in 2027, which is about a 10% compound annual growth rate. And then at that time, analysts are expecting a free cash flow margin of 35.8%, which is higher than it's been historically, right? And so to get an idea of where the stock would have to be trading at right now for it to be a profitable investment over the next 5 years, I've used this very basic modeling tool. No, it's not a detailed model. These are just broad general assumptions, but I think it does a decent job of giving us a low, a medium, and a high scenario and tells us what would need to happen for the stock to trade at certain price levels and prices over the next 5 years. So keep in mind those analyst expectations, about 30 or 13% revenue growth, right? So on the low end, I used that 13% revenue growth, a 28% profit margin, which is above their historical profit margin. So we have profits getting, better over time. Free cash flow margin right in line with their historical numbers. And then a PE of 20. Again, growth is going to slow down a lot here, so it should trade at a lower PE than it did historically. That's a big reduction, I got it. But if growth slows down that much, then maybe it deserves that kind of a reduction. Price to free cash flow ratio 21, and we're looking for a 10% return. The middle scenario is 15% revenue growth, 36% profit margin, 35% free cash flow margin, a PE of 24, price free cash flow of 25, and then a desired annual return of 12%. And then a high scenario is revenue growth of 25%. Remember, that's almost double the revenue growth that's actually expected. Profit margin of 38%, which is higher than expected. Free cash flow margin of 37%. A PE of 26, which Google right now, I think, trades around a PE of 19 or 20, just to give you an idea, or maybe even a little bit below that. And the S&P is trading right around 18 or 19. So well above the S&P 500, well above Google right now. And then a price-free cash flow of 27. You have and then a desired annual return of 14% per year. We have a current share price of 206. So down here are the prices that it would trade at if you believe any of these three scenarios. If you believe the low scenario, which is probably too low, but just showing it here, the share should be at $90 a share. If you believe the middle scenario, which I think is probably the closest to being true out of all of these, shares should trade at 135. And then if you believe the high scenario, that's what you would need to justify the share price today if you're looking at for a 14% annualized return. That would put the shares at, you'd buy them under 207 and they're at 206 right now. So if we want to bring that down to you're only looking for a 10% annualized return, then there you go. You could buy the stock all the way up to $246, which is about 20% higher from here, if you believe those to be true. But again, you'd get a 10% annual return versus a 14%, which if you're taking on higher growth expectations, you should build a little bit more risk into your scenario. This is the Everything Money calculator. You can check them out. I'm not being paid for this. I just use the tool because I think it's a decent tool for rough estimates, right? Alpha Spread is another tool that I use. Again, I just like to look at a lot of different tools, right? This one is actually a model that they use. They've got their own algorithm. They look at a DCF value that they come up with and a relative value, meaning compared to where it's historically traded at. In the worst case, they have it at 84% overvalued, and then or a drop of 84%. The relative valuation is a drop of 48%. The base case is still showing it way overvalued, and then even in the best case scenario, they have it minus 20% here, and then the relative valuation of 128, which would be minus 38% from the 208 closing price. And so really, no matter how you look at it right now, NVIDIA stock is showing as overvalued, right? Who knows what's going to happen when they report earnings? The market can do anything, but I invest on fundamentals and trying to own companies I think makes sense, for the long term. At reasonable prices. And as much of a fan of the company as I am, I just can't justify NVIDIA at these prices. So I am staying away from it into earnings, and I just wanted to provide this update for anybody that's looking at the stock. Now I'll tell you what I've done with my portfolio since I share it here. I have switched my newsletter over from Substack to Beehive, so the new address is investor.beehive.com, which is linked down in the description below if you want to check out my email newsletter where I share my entire portfolio, all of my transactions, and everything before I ever do them. My newsletter is the best place to get them because it takes a while to get these videos uploaded to YouTube. All right, real quick, just giving a portfolio update. $161,624. We have put in a total of $152,000. So since February 15th, 2022, we're up $9,100, which is a money-weighted return, which factors in money that has come in and out of the account and the timing of it, of 10.72%. Year to date, it's been a really strong year. We're up $34,000. $34,900 for a 31% money-weighted return gain. And you can see the companies I hold in the portfolio now. This has changed a lot recently because I've moved out of a lot of my favorite cloud and tech stocks because we are clearly in a tech slowdown, a cloud slowdown. And I just think that once I realized that, I thought those stocks were overpriced, at least in the short to medium term. I would love to own Snowflake, Datadog, CrowdStrike, all of my favorites. Again, I just need them to come down, down to more reasonable price to sales levels, which I outlined in the email newsletter. So right now, Google is the largest position. I've got a hedge that I opened back up again today, outlined that in the newsletter using SQQQ. It is definitely not up 28.61%. It's showing up $3,000. I've got advanced auto parts. I've now, oriented more towards dividend payers that I think are going to pay a nice dividend and increasing dividend. A lot of these companies are buying back shares, and I think that they're just generally undervalued, right? I think people are going to need to service their cars. People will keep cars longer in, a higher rate environment where they're not buying cars, they're not taking loans. If we enter some kind of a recession, this is pretty recession proof because people still have to keep their cars and they generally keep them longer and need to fix them and service them. Taiwan Semi, I just love the company, think it's very fairly valued, just my opinion. Meta, I think is fairly valued. Brookfield, I've talked about it before. Rocket Lab, this is my speculative play right now. Medtronic, which pays a nice dividend. Verizon, Fidelity National, and Brookfield Asset Management. All four of these pay a nice dividend. I'll go into a detailed video covering all of them. And then, what I will likely do this week is close this SQQQ hedge. Actually wrote a tweet talking about in November, December, QQQ traded down to 260. And so my guess is this little sell-off we're in takes us to around 270, maybe between 260 and 270. So that's roughly an 8% pullback from the current price. That was 295. We might be a little higher or lower than that. But essentially, that's what I'm thinking could happen to the QQQ. And so I've hedged with SQQQ, which is the inverse of QQQ. I did a video on it. Be careful with this. It's risky. Not recommending this for everybody or anybody, just sharing what I'm doing in my portfolio. The hedge was up nicely, and I could see myself, holding it really just this week. And then if the QQQ takes another move down tomorrow and SQQQ is up nicely, I may even close it out tomorrow. Again, don't follow me on this. I was just looking for a little hedge, and if I can get somewhere between a 10 and 15% gain on SQQQ in a matter of just a couple days, I would very likely close it. And what that would give me is then about $25,000 that I could invest in either, like undervalued company, maybe Google or Meta or something like that sells off. But what I would most likely do is invest it into a nice dividend paying or dividend growth stock. Home Depot today actually sold off quite a bit, about 6%, which is a lot for Home Depot in a single day. So if we see Home Depot fall a little bit more, or maybe even Lowe's fall, these are just two companies that I'm a huge fan of that are just incredible winners long term. Lowe's is trading a little bit lower of a PE right now than Home Depot, but Home Depot is, better on a profitability front and generally has grown faster. They've got a little bit of a higher dividend. The growth rate over the last 5 years has been about the same. Lowe's has actually paid a dividend 61 years straight, and then grown the dividend 61 years straight versus Home Depot of 13, but they've both paid an uninterrupted dividend for 61 and 34 years. That's just pretty awesome. If MasterCard and Visa ever came down, I would be interested in those. But Lowe's and Home Depot got me super interested. American Tower, pretty interested in that as well. So I'll share this out again in my email newsletter, and then in here in videos of what I end up doing with that hedge position, and then what companies I invest into. I'm not planning to short the market here long term. I'm not planning to hold a bunch of cash. Was just looking to hedge a little bit as last few weeks have been crazy, and I think the market got overvalued. We've got some tech companies reporting, and I just think people could get scared right now, and maybe the market comes back down into what I think is a more reasonable level, about 5, 8 to 10% lower than where it's at today. Who knows what's going to happen? Most of the time, you're better off just buying stocks for the long run, and people shouldn't be investing in individual stocks anyways, for the most part. But if you like it, if that's the thing for you, do me a favor, support the channel by subscribing, liking the video, sharing it with a friend. If you watch more than one video, our investor agreement is that you have to subscribe to the channel if you watch more than one video, and then check my email newsletter out if you want more detailed analysis and email alerts anytime I make any transactions. Have a great day.